If you bought equipment, computers, or other assets for your business this year, you might not have to wait years to deduct the cost. In many cases, the tax law allows you to write off most or even all of the purchase in the same year you buy it. But the rules depend on two key provisions in the tax code: Section 179 and bonus depreciation. Understanding how these two work can make a huge difference in your tax bill. Hi, I'm Aradhana Aggarwal. I am a CPA and my goal is simple: to help everyday people understand taxes without fear, confusion, or jargon. And in this video, I'm going to explain what Section 179 is, how bonus depreciation works, the differences between the two, and how business owners decide which one to use. Let's start with the basic concept of depreciation. Normally, when a business purchases equipment, the IRS does not allow the entire cost to be deducted immediately. Instead, the expense must be spread out over several years. For example, office furniture is usually depreciated over 7 years. Computers typically over 5 years. Commercial buildings over 39 years. This process is called depreciation and is meant to match the cost of an asset with the years it's used in the business. But Congress created rules that allow bonuses to accelerate these deductions. That's where Section 179 and bonus depreciation come in. Section 179 allows businesses to deduct the full cost of certain equipment in the year it is placed in service, instead of depreciating it over several years. Eligible purchases may include computers and office equipment, machinery and tools, furniture, certain vehicles used for business, software used in the business. However, there are two important limitations. First, the equipment must be used more than 50% for business purposes. Second, Section 179 cannot create a tax loss. In other words, your deduction generally cannot exceed your business profit for the year. This is one of the key differences between Section 179 and bonus depreciation. How bonus depreciation works? Bonus depreciation allows businesses to immediately deduct a large percentage of an asset's cost, even if the deduction creates a loss. Unlike Section 179, bonus depreciation does not have an income limitation, applies automatically unless you elect out, can create or increase a tax loss. This can be used if a business wants to reduce taxable income dramatically in a high profit year. Key differences between Section 179 and bonus depreciation. Although both provisions accelerate deductions, there are some important differences. Section 179 gives you flexibility. You can choose exactly which assets to expense and how much to deduct. Bonus depreciation is automatic. Unless you elect out, it applies to all eligible assets in that category. Another difference is that Section 179 is limited by taxable income, while bonus depreciation is not. This means bonus depreciation can sometimes be used to generate losses that carry forward to future years. Because of these differences, tax professionals often use both strategies together. Example of accelerated depreciation. Let's walk through a simple example. Imagine a business purchases $50,000 of equipment for operations. Without accelerated depreciation, the business might only deduct $10,000 per year over 5 years. But with Section 179 or bonus depreciation, the business could potentially deduct most or all of the $50,000 in the first year. If the business owner is in 30% tax bracket, that deduction could reduce taxes by $16,000 or more. That's why depreciation planning can have a major impact on cash flow. Vehicle purchases are one area where many business owners misunderstand the rules. Certain heavy vehicles, typically those with a gross vehicle weight rating over 6,000 pounds, may qualify for larger first year deductions. However, there are still limitations and detailed rules, especially if the vehicle is used partially for personal purposes. Based on the complexity, it's important to review vehicle purchases with a tax professional before relying on the deduction. There are several mistakes I see business owners make when it comes to accelerated depreciation. The first is buying equipment solely for the tax deduction. A deduction only saves a portion of the cost, so purchases should still make business sense. Second, forgetting the business use requirement. Asset must generally be used more than 50% for business to qualify. Third, not planning the timing of purchases. Equipment must equally be placed in service before year end to qualify for deductions that year. And finally, ignoring future tax consequences. Accelerating deductions now may reduce deductions available in future years. This is why depreciation planning is often part of year-end tax planning discussions. Accelerated depreciation is often most valuable when the business had a very profitable year. The owner expects lower income in future years. Cash flow allows for equipment investment. The business needs the equipment regardless of the tax deduction. Used strategically, these provisions can help businesses manage taxable income from year to year. Section 179 and bonus depreciation give business owners powerful tools to deduct equipment purchases faster and manage their tax liability. But the key is understanding the differences between the two and using them strategically. Because while the tax code allows these deductions, the best strategy often depends on your specific business income, goals, and long-term tax planning. If you are a business owner planning equipment purchases or looking for ways to reduce your taxes legally, it's worth discussing depreciation strategies with a qualified tax professional. And if you want more tax strategies designed specifically for entrepreneurs and small business owners, make sure to subscribe to our channel. Thank you for watching. See you next time. And don't forget to like and subscribe for more tax tips that are legal, practical, and intentional.